Okay, it's recording.
All right. Hey guys. Um, so I think the first important thing for everyone to know for direct sales taxes are that the IRS's stance on when and why you can take a deduction. So if the IRS, their stance is it reasonable and is it necessary? And that's your gray area of taxes. So just to kind of give an example, I went to an IRS seminar a few years ago, and they, it's like 500 people in a room, said to all of us, this guy takes a limo to the Four Seasons to meet a potential business client and then takes a chopper to the airport for a private flight. Is that a reasonable deduction? And everyone in the room says no, of course, because we're normal. And then they say, okay, he's Donald Trump. And then everybody changes their stance. So everybody's scenario that you create, the picture you create for the IRS, that's where you get to come up with your write-offs. So is it reasonable and is it necessary? If you have an argument that matches those things, you can take a deduction. So when it comes to direct sales, you want to start keeping track of everything you spend that allows you to make money. And that includes your use of your home, your use of your vehicle. You do not get to pay yourself for time. That's separate. So basically, you're going to take that 1099 that you get from your company, and you are going to then want to just subtract as much as possible from it, right? Everybody has to pay self-employment tax and Social Security. So there's always a balance due from a 1099. And in direct sales, there's just so many opportunities where you can pretty much zero out that liability. So the business use of home is a big one, and it's the most common forgotten deduction for you guys, which is where you get to take your office space, the space that you have in your home that's dedicated for work, and you get to deduct it against the expenses of your entire home. So therefore, if you have a 2,000 square foot home and you have a 140 square foot, office, we're going to take that percentage and calculate it against all the expenses of the house. So the cost of your utilities, your power, your internet, your water, your garbage pickup, your property taxes, your mortgage, or if you rent, your rent costs every month, repairs and maintenance. Now, this does not include upgrades, but like if you need a new roof or if plumbing goes down or something like that, if it's used in the house, it can go towards the total expense. And then we'll calculate a percentage. So that in itself is a deduction that is worth hundreds of dollars to most people. And it is the most commonly forgotten. Now, if you have a decent space in your home, but you maybe say you rent and you've got your utilities or something like that is all included, they have a safe harbor method for it as well that you can use. That'll give you a certain dollar per square foot. So if you don't have high expenses, you can get a better write-off that way. So that's important as well. But mileage on your car is the next big one. A lot of people save their gas receipts and you go for an actual expense write-off. That in itself will cost you lots of money compared to mileage. This year, IRS gives 57.5 cents per mile driven. So anytime you go to the store to buy supplies for a get-together that you have with your salespeople, or anytime you drive to a business meeting or some sort of convention, you get to take that. Did you drive to meet somebody to talk over coffee, about your business? You can write that off. So mileage is really important. There's two ways to keep track of it, obviously digitally and handwritten. It is legally acceptable to recreate it after the fact. So say for this year, for this year's taxes that you're filing, if you did not keep track of your mileage last year, you can go back and look at your trips and things like that and recalculate. That's perfectly legal. And as far as this coming year goes, if you haven't already been keeping track of it, go back and think about where you've been and can you document it with, or is it backed up with a receipt at the grocery store where you bought supplies for that party, things like that. And from here on out, get yourself either a pocket calendar, or there's a great app called Mileage IQ that works really well. That'll just keep track of those miles. A lot of people that do them later really lose a lot. And the average direct salesperson on the 2016 taxes wrote off a 5,300 mileage write-off, which is, worth over 2,500 bucks. So, that's a big one. And the way you back that deduction up is really important. If you get oil changes, things like that, something that shows the progression of your odometer, those are records you want to keep. If you change your own oil, contact me directly and I'll explain to you the weird way that you get around that. So your repair receipts and things like that from shops should be saved just so you can show the progression of the odometer reading. The one big thing that is done often in direct sales, which is wrong and is the most common reason that all of you get audited, is that you write off business startup costs. So if you have like a kit or something that you paid for from your business to start that business, that is not a write-off. And a lot of people will go put it in and they'll actually list it as startup. So make sure you don't do that. So like I said, so if you have that $200 buy-in, or I don't know what your company does, unfortunately, but whatever that is, make sure that you don't deduct that. Now, you can, however, continue to write off like purchases of product like your wine, things like that for tasting, stuff, supplies. But that initial startup cost is not deductible. Other than that, again, did you spend it to make it? So your advertising, do you have business cards? Did you buy logoed clothing from the company? Do you pay for a website? Any online domain is deductible. Cell phone use obviously is huge for everyone, so you can write that off as well. What you got to do with that is figure out what your personal use is for percentage compared to business use of your phone, so that you can calculate an appropriate write-off. Office equipment, you buy a printer, papers, staples, postage, all of that stuff is deductible. And any rental space, like say you go use a Best Western conference room for something, you can write that off as well. I think maybe if anybody had any questions specifically, you could either ask them now or you guys can email me. I do have a Facebook page that you can connect and chat with me on. It's the Tax Lady Beth Bennett, or my email is thetaxladybeth@gmail.com. And I do have some deduction sheets that I could email all of you that will show you what things, direct sales, like the most common deductions, missed and taken, as well as how you can get to your home office deductions and your mileage. So I've got a bunch of those sheets. And then, of course, a lot of you obviously do this probably as a part-time job, so you have another gig. And I can show you how to integrate those things. A lot of that stuff becomes pretty specific to your own tax return, the combining of things. But, the other thing that's important to realize is that there's not one place to put a deduction in a tax return. There are multiple places that you can follow the letter of the law and create the best version of the puzzle for you. So getting a bunch of those deduction sheets and seeing where you'll see, the same thing can be written off in 4 or 5 places. That'll allow us to look at your whole picture and find the best way to get you the maximum refund.
Beth, I did have a question. Actually, you answered it for me last night, but I was wondering if you would just share this information with everybody. I had messaged Beth last night. I had a question about team gifts. Did you want to explain that further?
Oh, yes. Okay. So business gifts. So if you're even sending a gift to someone who could be a potential client, customer, or just, a fellow company worker that you do things with, for business purposes, you can write off a business gift. However, what people think is that, I can send them a $75 gift basket and I can write that off. There is a limit. It's $25 per person per year. So that's really important. And again, good question, because that is one of the most common red flags in Schedule C, which is a self-employment tax return, which is the style that you guys will do when you get their 1099s. Um, there's a lot of confusion with a 1099 income and an itemized tax return. You do not have to itemize your tax return. You can do a standard deduction. So for those of you that don't know, a standard deduction is a set amount of your income provided by the IRS. For a married filing joint return, it's $12,700. For a head of household return this year, it's $8,800. A single person is $5,700. That's the amount of money that they take out of your income that is automatically not taxable. And then there's additional exemption credits, at least for this year, that they'll take them down. So once you get to that income, the ability to itemize is really decided. Is that standard deduction they provided you larger than your itemized deductions, or is it smaller? If it's larger, then you want to itemize. If the standard deduction is, if the standard deduction itself is larger than your itemized deductions, then you're going to want to take the standard. And a lot of people in direct sales think that if they take the standard deduction, they can't take these expenses. And that's what separates you from a W-2 job. So anybody who gets a W-2 can only write these things off in an itemized scenario, and they have to hit, a certain number to be able to take them. You guys could take, if it's $1, you get to take it. If it's $5,000 against your income, you get to take it. So it's really important that you keep track of your expenses, and really know, especially if you're using the same bank account for your personal life, or for all all things that you do and produce income for. If you're using all in one account and the IRS was to audit you, they are going to want to see that you have kept yourselves records that show the difference between personal and business expenses. So keep, an Excel spreadsheet. Some people like QuickBooks. For those that don't have an accounting background, it's kind of a pain. I do have an accounting background and I don't like it. But Excel is great. So just make yourselves a little spreadsheet on Google Docs or Excel that will allow you to kind of keep track of your expenses per month. And then try and do it once a week. If you can go in once a week for 10 minutes and keep track of things, that's good. Another big thing to remember is that with the tax code changes that are coming into play next year, there's a lot of people that are used to itemizing on their tax returns that will not be able to do that anymore. Because the standard deduction has gone so high, it's going to be harder for most people to write off anything extra. And because of that, all of the people that work for the IRS, they need something to do. And small business, direct sales, the percentage of audit is likely to go up for you guys substantially. So keeping track of your expenses is really important. And with an audit, everybody sees some horrible scene in a movie where you're sitting with an IRS agent, and that's really not how it goes. The first thing they're going to do is send you some mail and tell you to prove your expenses. If you've kept that spreadsheet and you have your receipts, and you just do that on a regular basis, your audit, it's already done. And if you guys send, like I said, if you send me an email or a message on Facebook, I can send you a template to keep track of your expenses if you'd like. And that will allow you to not only keep your books, but it will allow you to keep your books in the organization that the IRS is going to expect them. And it's really easy to keep it up to date. I mean, you could spend 30 minutes a month only and stay up to date. But if you don't do that and you do get an audit, you'll spend days and you'll lose money. So that's a really important thing to do. So please feel free to send me a message to get the template and, and anything else questions you have. But, and then the other big important thing with reviews is the IRS does not review things quickly. So right now, the most common year that they are reviewing is 2015. And for the simple reason that it is more economical for them to wait. If they find that you're at fault and they've waited, they get to charge you penalties and interest, and that pays for the payroll that it went in to investigate your problem. So a lot of people, they get their money from the IRS or the state, and then they just move on to the next year. And so it's important to keep your records for 3 years, and it's important to keep your receipts especially. But receipts don't hold up for 3 years, so you should scan them, or like if you have a Gmail account and you just took a picture of every one of your receipts that you're using as a write-off throughout the year, Google's going to save them, and they're going to save them in the cloud for a decade, and you'll be fine with that. But without those, I fear that a lot of people in the direct sales world are going to start seeing more increased reviews on returns, simply because there's not much else left to review but businesses and corporations and direct sales. So those records are going to be really important. Nicole, do you have anything else to add?
You answered a good one when Josh and I called you the other night about clothing. I know that's one thing here. We're often told that if we buy a shirt that has wine on it, we can write it off. So can you explain a little bit about clothing write-offs?
Yes. Okay. So clothing write-offs kind of follow the rules. We call it the grocery store test, which is if you go into the grocery store at the end of working an event or a day of your job, do people know what you do based on what you're wearing? So nurses, vets, all those people, that are in scrubs, right? We know that. So that's pretty obvious. But me, I work in an office. So I put on a dress and some shoes, and I could do anything, and I don't get to write them off. The difference is the uniform strict and required? And if it's personal clothing, is it logoed? Like if you buy something from your company, through one of their catalogs or something, it's got the business's name on it, that's deductible. But if you buy a shirt that that just says wine on it, like Nicole said, that will not be deductible. There is a standard cleaning deduction you can take for each year. It's $8 a week, and that's for laundering. But you got to think about, in your case, if it's a part-time job, you should really cut it down to a 4-day-a-week write-off to not get called out on that. Logo it, or if it's embroidered with your name and your business company, stuff like that, then you're going to be able to write it off. But if you just bought a nice dress to go to a business meeting, you do not get to write that off.
God, I wished we could write off our gala dresses. That would be so nice, wouldn't it, Heather? Heather and I buy really nice gala dresses.
That's good. You're supposed
to go all out.
If I didn't have an office to go to, I would only buy yoga pants. So I feel like I should get to write off every dress and every pair of high heels I'm ever forced to
wear. Did anybody else have any other questions for Beth? I see there's a couple of you guys on. You can use the chat or just go ahead and unmute yourself. You guys had any questions? I know I had a ton of questions when I chatted with you, and you were super helpful, Beth, because I know I have a lot of people on my team that have been saying they're going to file their taxes themselves versus using a person, and they didn't see necessarily the value in using somebody to help them file. So,
well, one of the things that I would say with that is if you're used to filing online, whether you've been in direct sales before or not, perhaps I make you an offer that go ahead and do them, but don't send them. And then if you want to email me your stuff, I will do your return. And if I don't beat that number, then I would tell you to file on Turbo or whatever program you're using.
That's a good deal. That's good. Well, thanks, Beth. Anybody else have any questions for Beth? I just want to remind everybody, Beth is not associated with the Traveling Vineyard in any way at all. Beth was my neighbor growing up as a kid. I asked to come on tonight to ask some, be able to answer some questions for anybody that had questions or be able to explain some things more. Heather, did you have any questions?
I was just curious, why isn't I've been doing this for a while, so I don't have to worry about it, but I was just curious why the startup cost isn't tax deduct, or isn't an expense.
Deduction. The IRS states that more than 72% of businesses don't pass the startup phase. So most people that sign up for direct sales or even start a business will create a tax return and get it as a write-off. And in the end, they'll show a loss on the income and
Right.
they'll profit on that part. So the
Okay.
is only willing at this point, I think they changed it in 2013 was the rule change. But when they changed that, it was anything past that startup, but that initial investment into the business is not deductible simply because lots of people buy it, use the
Mhm.
product themselves. Like I'm a good example. I bought into Unique Makeup last year. I have no intention of selling makeup, but I love their makeup. And I got a really good buy on a nice big kit. You know what I mean? That if I had been somebody else and I sell makeup to my mother because she likes it too. But when I invested into that, I invested into it for my own personal gain. And the IRS's view is that many people do it that way. So they do not allow it anymore. That being said, I'll bet about 80% of the people that are in the business write it off and get away with it. If you didn't label it startup costs and it was just supplies, unless you were the unlucky selected auditor or auditee, you would skate through without issue.
That's good to know. So it used to be you could, but now you can't. So that's
Yeah, like I said, I think it was 2013, really kind of when there were a couple companies that really took a big boom in income, like in the 2 years prior, and the IRS started to get a little bit more specific in their rulings.
Beth. Gretchen Miller had a question, and maybe you understand this. She said, so we should file a Schedule C tax form, not a Schedule A or B?
Okay, a Schedule C tax form is for self-employment and 1099 income. So that is what you're going to do the traveling vineyard income on. A Schedule A is itemized deductions. That's totally separate. So again, that's going back to, are you taking a standard deduction or are you itemizing? So a Schedule A is a totally separate decision. The C is absolutely required for the 1099 income, though. You have to do it. So anybody who's made more than $600 from Traveling Vineyard will need to complete a Schedule C tax return. A Schedule B tax return has to do with stocks and things like that. And therefore, you know, again, that's a totally separate issue as well. That's dependent on each person's scenario, what kind of income they have, what kind of sales things they have.
Go ahead.
But you should all be doing a Schedule C in tax return.
Good. I had no idea what she's talking about because I don't do my taxes. So
That's what I'm here for. Yeah, no, I mean, this, like I said, the schedule, like there's a bunch of schedules. There's E's, D's, B's, C's, you know, they win all the letters. But there is no way to properly do your return without a Schedule C.
Okay. We had a question the other day on the page, and I see Tracy's not on. Tracy's question was, she joined last year but made less than $600, so she didn't get an income tax form. What should she do?
Well,
Could she still
it's
claim
going
her
to
business?
depend on if the money that she made, that less than $600 on, came off the initial investment of signing up for the business, or if she participated financially in it after the initial setup. If she spent more money than the initial setup, you know, drove places and things like that,
Yeah, she did.
she can just simply claim the income she knows she's made. She does not need a 1099 for it. You know, there's lots of people that do their own businesses of all kinds and will never get a 1099, you know, landscapers, things like that. And in this sense, you guys are the same when it comes to the type of tax return you're filing. So, you know, I own 3 businesses and I don't receive any W-2s, but I also don't receive any 1099s. So I have to keep track of all my income and report it myself. So that in that scenario, that's what she should be doing. Just report it. But again, if she didn't financially participate with money, not just use of vehicle and things like that, further than what she sold to make the money she made, then it doesn't go on her tax return at all.
Good to know. I'll let Tracy know that.
Mm-hmm.
Good. Did anybody else have any other questions? Beth, you've been super thorough and knowledgeable. I really appreciate you taking your time out of your busy schedule in tax season right now to get on and talk with us. And then just real quick, Beth, drop a line where you mentioned we can grab some forms. Where did you want us to go?
I have some of them on my Facebook page, and I'm quite certain the office and direct sales are listed there. And that, if you just search on Facebook, The Tax Lady Beth Bennett, you'll get my page. I'm based out of Southeast Georgia. I'm from New York. I have about 350 clients, and I've probably never met 160 of them. So just kind of wherever, all over the states. So, you know, I can answer questions for you guys from whatever, you know, and I don't really run strict business hours. Don't talk to me before 7 a.m. so that you still like me. But other than that, we're good to go. So yeah, so the Facebook page is The Tax Lady Beth Bennett. And you can also send me an email. My email is thetaxladybeth@gmail.com. So yeah, so, you know, hand it out like candy if you want. And what I can do, I can go ahead and tag you in like a little ad on your Facebook page, Nicole.
Perfect. If you want to do that, and the Nicole Wine page, Beth, go ahead.
Okay.
That'll work perfect, so anybody can pick that up from there.
Yeah. Yeah. So if you have specific questions, feel free to you know, to send me a message or give me a call, whatever. And again, you know, if you're used to doing your taxes on your own, it's really important to know that I don't like to make money off people who don't need me. So feel free to prepare your taxes, and you know, if you don't send them, this will make this much better. You know, don't send them, hold them off. And if you'd like to send me your stuff, I will do your taxes. If you do not wish to file with me, if I didn't do any better for you than you did, then you can go your way and I'll go mine, and there's no fee. And you know, just go that way. And if you guys have any returns from prior years that you would like reviewed, in about another, I don't know, say 10 days, I'm through my real initial peak part of the season, and I'll have time to start reviewing those.
Perfect. I know Josh and I had decided we were going to go that way. Beth's going to review our last couple of years for us.
Yeah,
So,
sounds good.
well, thanks so much, Beth. And Heather's going to close out the meeting because she's the host, so she'll be able to keep the recording too. So Beth, if you wanted to use this recording for whatever you need to as well, just let us know and we'll send you the link. But thanks everybody for taking a half hour of your time tonight, and especially you, Beth, for answering our questions and being on tonight. I know I learned a lot, so thank you.
All right. Well, thanks for having me, guys, and good luck. And like I said, just message me if you have any questions.
Yeah, good. Thank you. Have a great night, everybody.
You too. Bye-bye.